Okay, I think we'll start now, and then if people join late, they can join late. Otherwise, I know there's quite a lot of people who want recordings as well. So let me just sort of introduce myself. I think Chris can perhaps introduce himself when he does his presentation. Basically, what I do is I write the Brookville Capital Intelligence Report, a weekly report that gives ideas in the sort of junior mining space across different commodities. And as you can see from this presentation, one of the things I like about it is you can get sort of venture capital type returns from some of the junior miners. I gave Chalice out as a freebie on the website, went from 15.5 cents to over $10. I think it went to about 10.47 or something. After that, I gave Arizona Lithium out as a freebie. That went from 4.3. It's currently at about 15.5. But if you had invested when I first mentioned to you, you've also got some free shares in a company called Diablo. That's done so well, I feel like I need to take it off my freebie list because even though I like it a lot at the moment, the whole idea was to get in early, and I think 4.3 was a pretty attractive price. So my new company is a company called Stakeholder Gold that Chris is the CEO of. He's going to tell you a bit about Stakeholder, and you can find out a bit about them after I've done a brief sort of run through about Brookville, which will take about 10 minutes, and then Chris has got probably about 10 minutes on Stakeholder. And it's a very exciting sector. But let me just crack on and tell you a bit about it, because as you see at the bottom of this screen, if I'm honest, it's mainly through Chalice, but I've got about 40 stocks in my portfolio, and Chalice is one, but you only need one to do well. And I ended up tripling my portfolio within 9 months. Arizona's doing very well. I haven't updated the numbers because I sort of ended up taking a large chunk of money out to do other things. But things have gone very well, to put it mildly. So just sort of moving on, I've got, I really want to sort of talk to you about what happened in the past, because obviously we don't know what's going to happen in the future. But in the past, home state mining and dome mines, and this is talking about the crash of depression of 1929, 1933, and let's hope we don't have that. But what you can see is even when the market really went through a horrible time, these two major producers did very well. One up 4.74%, the other 5.58%. I don't know what the equivalent of them is now, but I would have thought something like Newmont and Barrick wouldn't be a bad guess. But I do need to stress that's a guess rather than anything else. But the point is, when markets are tough, and especially if you've got inflation, things like that, then having some commodities in your locker is not a bad thing, because things go up in price when you've got inflation, and commodities are used to make things. So logically, if your end products are going up in price, then hopefully your commodities are as well. Let's just talk about very briefly what I do. I use a very simple system. I call it the 3 R's system. You obviously need time and money. In terms of how much money, I think about 10 grand. This is obviously your own money. You don't say anything to me, but I think having 10 grand of your own money means you can invest £1 grand in 8 stocks, and you've still got 2 grand left over in case the market crashes. And I think 8 is the absolute minimum you want to be in. Ideally, you want to be in more than that, but I think 8 is, it's probably as low as you want to go. So really, that's what you do. What I do is I provide you with the research. I use what's called the bridge system, which I'll take you through. I've been in the market for a long time, which I'll explain on the next slide. So I'm able to rationalize what is thousands of companies into what I view as the best of the best. And Also, I use a risk management system. I use a fancy football team concept. So the really big companies like the Barracks, Newmont's, Wheat and Precious Metals, I would view them as what I call goalkeepers. And then you've got defenders, which are sort of large producing commodity companies. Midfielders are companies that are probably new to production. And then your forwards, your out and out explorers. Now, your forwards is more of your VC return. Your defenders and goalkeepers, I'd describe them more as sort of private equity type return, and midfielders probably sit somewhere in the middle. So, as I said earlier, I mean, there's thousands of stocks to choose from, and one of the reasons people use me is because I kind of select for myself, because I invest in everything that I tell you about, because I'm actually really telling you what I'm doing for my portfolio, and then people are deciding what's right for them. And so I basically pick what I think are the best. And very simply, you can split the market really into two groups. On the one hand, you've got producers. On the other hand, you've got explorers. Producers tend to be lower risk because they've already found the commodity, and their risk is more to do with extraction and the commodity price. Explorers are much higher risk because they're actually looking for it. But one of the things I like about exploration is obviously technology has improved dramatically, but that doesn't seem to have impacted the share prices of explorers. A great example is drones. Drones mean that you can explore far more cost effectively than you used to be able to, but you haven't found that explorers' share prices have gone up because that element of exploration has become a lot cheaper. But where I'm coming from is I think that you need to have a diversified portfolio, and I would say you need to have a bit of both. And you can kind of, depending on what your level of risk is, if you want to have what I view as my own risk, I've got everything, but there's probably 2/3 midfielders and forwards for me, and 1/3 goalkeepers and defenders. But if you want to be more defensive and more careful, you could have more goalkeepers and defenders. And if you really like to have high levels of risk, and this is really punt money for you, you can have more midfielders and forwards. The bridge system that I use, and one of the key things I do with the newsletter is, as well as give you ideas, I really want to educate you on how you can analyze companies. The whole idea is to sort of get you the fishing rod and teach you how to fish rather than just deliver the fish for you. So the bridge stands for balance sheet. I want you to make sure the balance sheet is right for the company, and I sort of show you what to look out for. And when I analyze companies, I use this system, so I sort of highlight what I like about the balance sheet, and sometimes what I don't like about the balance sheet. For example, if it's an explorer, I like them to have some cash. I don't like them to have debt. If they're actually generating cash, I'm not so worried about them having debt, providing they can service it. Resources, that's really, what do they have and are they likely to have any more? Infrastructure, that's incredibly important, because there's no point having a massive resource if there's no roads, power, water anywhere near you, because if you do decide you want to go into production and raise money, anyone who's going to contribute money to your project wants to know how you're going to process it. So you do need infrastructure around your deposit. Diversity is more to do with having a broad portfolio that I just touched on. Grade, you need to look at if it's economic, and really simple things like, what's the depth of it and what's the recoverability of the ore, because you could have something that's a very high grade, but if it's half a mile down, then it's probably not as good as a lower grade near the surface. So you need to kind of think about these things. And then exploration, which is really important. What's the potential? There are certain companies out there that, on the face of it, they look very good. But if they've explored 90% of their tenement, there's probably not a huge amount of upside. Whereas if you've got a company that's only explored 10, 15% of their tenement, I mean, Arizona puts itself out there as only exploring 4. I think that's probably a little bit light, because there's a lot of them, their tenement, that they probably wouldn't want to explore, but it just shows you the potential. And it's really important you understand this, because as what I'm saying here, you want to build a bridge between what you have and what you want, and you need to know how to build that bridge and where to put the bridge. Otherwise, if you're not careful, you're looking at the wrong companies and you're carrying out the wrong analysis. So just looking at the risk management that I touched on earlier, I view the stadium as the sort of physical metals, physical commodities, so gold, silver, platinum, palladium, copper, uranium, nickel, whatever it is. The goalkeepers are typically the largest mining companies that are actually mining that commodity, and some of them are mining lots of different commodities. Defenders tend to be more specialist about one commodity, and they're typically called mid-tier producers, so they're not as big as the real giants in the industry, but they're pretty large. Midfielders tend to be companies that are previously forwards but now coming into production, so they've lost some of the magic dust of exploration, but the share prices can still do very well. And the forwards are your out and out explorers, and if they find something a bit like Chalice did, the share price can just go ballistic. But as I say here, your investments must match your appetite for risk. There's no point not wanting to take much risk and then having a whole load of forwards, because you have to make sure that you're sensible about the level of risk you're taking. And these stocks can be very volatile. They can move 10, 15, even 20% in a night, and so you've got to make sure that you've kind of got the stomach for the higher risk stuff, if that's what you want, which is why I like to have a blended portfolio, because if some have moved a lot either up or down, you probably find others haven't moved as much, and therefore your overall portfolio hasn't been massively impacted. So again, perhaps look at not only your appetite for risk, but perhaps age is important here. If this money is very important to you and you're older, you've probably got less time for things to happen. And so if you're older, you probably want to have more goalkeepers and defenders. If you're younger and you've got more time for things to happen and you don't need the money so urgently, you can probably have more midfielders and forwards. But I think it's nice to have a bit of everything. Right, what can happen if you get it right? Now, I don't have Arizona on this list, but Chalice, you can see that actually that dot is 15.5 cents. It went to, I think, $10.48. Arizona's done well, but I've got 2 others on this chart. I've got plenty of others that have done well, but as you can see, the second one went from about 0.1 to 0.5, so that was a 4-bagger, depending on how you want to calculate it. And the other one, I'm not sure what that is. It looks like about 50 cents ish, perhaps 40, but that went up to $4, and it's come down a bit, but people are still making good money. So that's really what this is about. It's about having a blend of these kind of stocks, so hopefully you can make some really good returns. So just to kind of wrap things up, I think there's a recipe for success, but you need the right ingredients. And what I'm trying to do with the report is give you those ingredients and show you what I'm doing, and then you can decide whether or not it's up to you. Clearly, there's no guarantees. I don't know what the market's going to do, but I think by having a diversified portfolio, different commodities and different currencies, you're sort of preparing yourself as best you can. Personally, in this sort of unusual times we live in, I don't think it's ridiculous to have at least 1% in your portfolio. I know a lot of people have got nothing in terms of commodities. I don't know how much you've got, but I'd certainly suggest you have a look at it. If you want to contact me, those are my contact details, Simon Popple at brookvillecapital.com. And I'm doing a special for this webinar. If you go to my website, which is www.brookvillecapital.com, if you want to subscribe, this deal closes on Saturday. But if you type in, basically you have to click on the full amount, and then you put in your personal details, but before it asks for your bank details, it'll ask for a coupon code. If you click on that and type in webinar, then you basically get last year's price, which is 445 for the year, rather than this year's price, which is 545. So you get a discount for attending this webinar. And this is sort of standard important information, but I'm not regulated, so you do need to speak to a financial advisor about buying and selling shares. And I would strongly suggest that you are careful about the sector, because, as I said earlier, it is very volatile. So so that's basically me.